and welcome to this edition of Closing Trades right here on ET Now with me, Aisha Faridi. And for the markets, the range movement continues, although there have been some attempts to try and scale back. Right now, we're sitting in the green at about 70 points higher, above that 25,200 print right now. It's banks, to be fair. They were the ones which saw the first signs of a pickup well within the first hour of trade. And then from there, it's now auto, chemicals, capital goods, some of the pharma, select pharma names as well, which too have picked up. But still a lot of uncertainties with regards to tariffs, the kind of repercussions and ramifications it's going to have for global growth, and of course, how India is positioned within that piece. So let me welcome on board Florian Nato, CFA, Head of Investment Asia at Amundi, joining in on the show right now. Florian, good to have you on ET Now. Thanks for your time today. Let's first talk about the tariff impact on Asia, because, I was just going through your recent note, and it mentions that macroeconomic impact on U.S. tariffs on Asian markets has been limited so far. But tell me, how are you at Amundi adjusting your Asian investment strategies to try and prepare for a potential escalation perhaps in US-China trade tensions or broader tariff policies?
Yes, thanks for having me. Indeed, the situation is quite fluid. Almost every day you have a news related to tariff with a number associated to it. So I think we try to take a step back, assess a bit the long-term growth we're having in the countries, the monetary policies that is very much at easing everywhere in Asia. But if we dig back into the tariff level, after a few days where the US administration has been extended the deadline to August 1st, but at the same time, penciled down some deals with countries in the region, what we can see is that, one, you will have an aggregated effective tariff rate that is higher than what has been initially anticipated. So for now, you're right to mention that the market has been looking through it, but we do believe there will be some impact in terms of GDP growth for the second half, and there will be as well some revision lower for EPS in general, not only in Asia, but just because the level of tariff will be increased. The second point we are looking at very cautiously is the fact that there have been some measures in the UK deal, in the Vietnam deal, that are linked to sidelining China, especially it has been mentioned about transshipment. It's not only China, but we know China is the main target for the US administration related to transshipment. For Vietnam, South Korea as well, companies are very much involved in it. But in general, what we are sure of is there are some measures that will be as well in other countries, deals signed with the US, that are trying to put China in a complicated situation in terms of transshipment. The methodology is not clear. Is it a supply chain diversification, or if it's a pure transshipment? And it has very, very wide impacts. But in general, we do believe that despite the fact that we have tariff, and despite the fact all things being equal, it's a bit deflationary in Asia, and you will have a slightly lower growth and lower EPS expectation. We do believe that Asia equities are still relatively appealing in the global portfolios. And we are as well positive on Asia bonds in local currency, because we have the dollar as well that is in a structural bear market. And we do believe that tariff can help the dollar over the short term, but we are in a structural bear market there.
Right. But Florian, you were highlighting a constructive stance on Asian rates and duration, particularly favoring quality investment grade or IG corporate credit. Which specific Asian markets or sectors do you see as offering the best opportunities for IG bonds, and why?
Yeah. So first, the background. The background is we have disinflation confirmed in Asia. We have central banks that have been entering into a prolonged monetary policy easing period. RBI has been surprising with 50 basis point cuts as well in June. So and the background as well is FX has been resilient. So this is not something common. So we have a break in terms of correlation a bit between what's happening on the Asia central bank side and what's happening between Asia FX and US dollar, especially the low yielder FX. So in general, we tend to prefer the IG versus the high yield, as you mentioned, a bit high quality. We are turning a bit more high quality. Why? The first one is the risk reward we're having on high yield right now is a bit less appealing than we can have maybe 3-4 months ago. Spread have been tightening quite significantly. So in general, we prefer to be in cash earner issuers that are of a good quality. When we dig deeper into what kind of sectors we like or what kind of country we like, we do believe that it's important to keep in mind the FX and our view on the underlying FX as well. When we go into Asia, IG in US dollar, when we go into hard currency, this is not a big issue. But when we are going as well into credit in local currency, we do prefer areas where we are positive on the currency. And those are Indonesia rupiah and India rupee. The recent move we're having on FX is we like as well Korean won and we like the renminbi. So we have been reducing our underweight, and we do believe that those low yielder will be more resilient than initially expected. In the high yield space, the ones that we remain quite committed to is the India renewable space. So we have been participating into new issuance in that space, and we are having another weight in our portfolio. Apart from this, we like the tech on the China and on the Korea IG. So those are basically the ones that we like the most currently in our portfolio in terms of issuers in the investment grade space in Asia.
I want to talk about specifically, when it comes to China, because you remain neutral on Chinese equities because of the issues like housing market weakness and deflationary pressures as well, which persist. What specific domestic opportunities in China are you at Amundi exploring, and what would it take for you to shift to a more positive outlook?
Yeah. So on China, I think if we take a step back, you look at the 3-year period and you see that China has not been rewarded, to say the least, in relative terms. In year to date, China and especially offshore stocks are very strong performer, more than 20% performance for MSCI China. So you did mention about the structural issues, rebalancing issues at play in China currently, and they are very much clear. Supply overcapacity, and you mentioned about the deflationary, especially in the private sector. The residential real estate, we had some positive feedback loop on tier 1 city in the beginning of the year, and now it's a bit more under pressure again, so it's weakened again. It means that the period of healing will be longer on the real estate. And we have as well the fiscal stimulus that has been, to say the least, below expectation in terms of delivery. The powder is still dry there. And we do believe that the administration, the authority, will step in with a more decisively fiscal stimulus. But for now, it was not necessary, or it was not perceived as the first priority. So when you mention about where we see some opportunities in China today, so we are neutral, but we have actually a barbell approach. We like specifically offshore versus onshore. Why do we like offshore? So basically H share. And we do believe that there will be a prolonged momentum. The first one is supported by steady southbound flows. So mainland investors in China are investing heavily into Hong Kong quoted Chinese stocks, and we had record high flows in year to date. The second point is we have a very strong and abundant liquidity in Hong Kong. To defend the peg of the Hong Kong dollar versus US dollar, the Hong Kong Monetary Authority have been reducing rates, pouring a lot of liquidity. They are now withdrawing liquidity progressively, but they want to make sure that what we see in Hong Kong in terms of real estate recovery, what we see in Hong Kong in terms of flows coming in, is not basically put on the sideline. So they are very cautiously withdrawing liquidity. It means that when you look at HIBOR 1 month, you still are below 1.5%. We see more than 3% difference with the US dollar. And with a robust IPO. So the pipeline of IPO has been very strong in year to date. It was not the case for the last 4 years, and Hong Kong is at the top of the board, well ahead of London, for example. And on H2, we have more than 100 companies, not only Chinese companies, actually, you have as well companies in Asia, other Asian companies, non-Chinese, that want to get quoted in Hong Kong. So all this means that we are very happy to be long offshore Chinese stocks, and especially we like the tech platform. Then when you mentioned about when we will turn more positive, we will turn more positive, and it will be through A shares, so mainland Chinese stocks, should we have a bit more news on the fiscal stimulus. We do believe that if the authorities are serious about the 5% GDP growth for this year, they will have to move more decisively, especially that what we are seeing on the real estate side is not very positive. And knowing all the different context in terms of trade and tariff at place. So you cannot rely heavily on trade and export that it was the case over the recent years. When you think about consumer and all the stimulus stocks, it will be on A shares. So for now, we have a bit of consumer stocks in China. We are neutral and in general slightly underweight on some, and we will turn more positive should we have a probability of more fiscal stimulus increasing over the coming months. And we do believe it's a Q4 story. It can be even earlier, but in Q4 we will increase further a bit the consumer name we have in A shares. So for now we have technology in H, where we are overweight. We have some consumer names in A, but we have more powder to increase, and the rest is very bubble because we have high yielding stocks to make sure that we don't have a very high beta on Chinese equities right now.
Sure. Florian, I want to talk about India's growth potential as well, because you've been very optimistic about India, citing policy easing and growth surprises. How are you positioning your portfolios to capitalize on India's growth, particularly when it comes to sectors like consumer staples, communication services, and of course, real estate too?
Yeah, indeed. I think first, in terms of strategic views on India, we are very positive on India. It's a structural growth story, and we have been increasing further our GDP expectation for 25 and 26 last months. So the growth premium of India versus other emerging economies is increasing in our view. Over the last years, what we've been doing as well is we have been reevaluating our global and Asian strategic asset allocation to make sure that India will receive a structural higher exposure, higher weight in our portfolios. We will not come back why India and so on, but I think more tactically, what will be interesting to see if India can benefit from the China +1 relocation, and especially on the manufacturing sector. We know that India is very much at the forefront and leading on the services side, but they can do a bit more on the manufacturing side. So this will be interesting. The fact that from a geopolitical point of view, India is very much non-aligned, as said, is perceived as a strong advantage versus the neighborhood equity markets in investor views, because we are right in the middle of the current trade reshaping, and we do believe that the deal with the US will be announced in the next days. So I think it's just a matter of president signing the deal, but I think it's well advanced. From a portfolio construction, the way we are perceiving India as well is slightly different within an Asian portfolio or a global portfolio, because it's very high quality stocks that are not very cheap, but it's normal because it's a quality you need to pay a price for the quality you get in the portfolio. So from tactical, we are not that overweight on India. Actually, we are neutral from a tactical point of view. We have skin in the game strategically, but tactically, what we've seen on the earning revision side, we have been seeing initial sign of bottoming out of some earnings revision across sectors, but that's not been improving as much as what we are seeing in other EM economies and other EM companies. Foreign investor flows after leaving the countries for 6 months, and this was quite clear, right, from September last year to March, have been coming back, but they have been coming back relatively moderately. So where are we ending up now? We have a stable EPS growth in India. Our view is we will be around 14 to 15% for 2025 full year. But we would like to see confirmation of more private capex before increasing further our stake. You did mention about some sectors. We do like consumer services, but as of today, we try to be quite cautious and have a slightly underweight position on pharmaceutical areas in the country.
Right. But what about India's equity valuations? You think they may become a hurdle because of the recent re-ratings? And how are you navigating these high valuations in India equities and maintaining a disciplined investment approach?
Yeah, I think it's true. It's a concern. It's one of the major concerns is the valuation. But as soon as earnings delivery is there, you can see that as well in the US, where you have a lot of growth stocks. You can leave with higher valuation as soon as you are delivering on earnings. For now, what our main issue here is the fact that private capex has not been very coming back strongly, and we do believe this is the main way of delivering more earnings going forward. So it's always having a view on the sector, and then you look into bottom up. And we are not possibly concerned about the valuation. We do we do have some concern on the mid cap, but on the large cap, we do believe that as soon as the earnings revision is moving a bit higher and the company is able to deliver a bit more, and I think having the dust settling down a bit with the deals that will be announced soon between India and the US, then you can reassess a bit more what we have in mind in terms of delivery, and this will not be a big issue. I think we can live with a bit temporarily more expensive valuation as soon as earnings is coming back and you don't have a pure re-rating.
Right. But what about, policy easing and growth surprises here in India? Tell me, how is it that you're adjusting your fixed income and equity strategies to try and leverage the potential interest rate cuts by the Reserve Bank in the remainder of the year? And which Indian bond or equity sectors look most attractive to you?
Well, I cannot enter into too many details on the India bond side per se. We did add some SSA that we do believe are quite appealing in this environment where RBI is cutting, and we do expect that RBI will cut more into the second half of this year. So we add some SSA that are quite appealing in terms of portfolio construction and high carry in our portfolios. We do commit more into India renewable bonds as well, where we see some very strong investment proposition versus the other part of Asia high yield right now. So where we have still some good carry when the spread are not super tight, but when we have the RBI behind that is making sure that liquidities will be pouring and the monetary policy will be more accommodating. So when we look into the difference between fixed income and equity allocation in our portfolio, in this current environment where you are in a rather late cycle and growth is decelerating, but earnings are relatively maintained, and in India it's a double-digit earning per share that is expecting for this year, it's an area where you want to be long equity and you want to be long duration. And so this is a period of time when we like both areas in our portfolio, and we are overweight duration in India and overweight as well India equities. On the tactical point of view, we are just neutral on India equity, but on Asia equity, we are overweight.
Florian, I also want to talk about the geopolitical risks, because with rising uncertainties such as Middle East conflict potentially affecting oil prices and supply chains, how is Amundi managing these risks in Asian equity and bond portfolios? Yeah,
indeed. So if you look only into company fundamentals, you will miss a lot of what's happening on the market and as well on market prices. So when you look back into the company's share price, you may not find all the reason back into fundamentals. So what we've been doing is, one, acknowledging the fact that economic warfare is at play. And it's increasing in the recent years. So we've consistently seen level of protectionism, level of export control, level of sanctions that have been increasing, and U.S. administration of late has just accelerated further this trend. Economic warfare most of the time can as well evolve into war, and this is what we're having in some very hot region currently. So what we've done on our side, conscious of this, is to develop our proprietary geopolitical sentiment tracker. And this is something we are monitoring on a weekly basis, and we are taking decision on a monthly basis as well. And when we look into it, you see that you have some spikes currently on the geopolitical sentiment tracker, while the market is looking through it purely. Of course, you have been seeing a bit oil price moving up, but they're coming back down very quickly as soon as you have a few news on Iran, for example, or as soon as you have OPEC increasing a bit production. So you do believe that supply then is moving up, and then the market is looking through it. In our view, the main geopolitical issue we have currently is a tariff, and the tariff impacts will be delayed, not derailed. So this means that economic growth and earnings will be moving down in H2. So what do we do from an investment perspective to take into account this news is the fact that we don't want to fight the momentum in risky assets, but we acknowledge the fact that geopolitical sentiment tracker is moving up and the market is not pricing a risk premium on this one. So we have been reinforcing last week again some hedging in our portfolio. So how do we do this? The best way to do it, in our view, is via optionality currently, because as the market is not pricing for it, implied volatility, especially on equity indexes, is relatively cheap, is cheaper than average over the last 5 years, while we do perceive that there is more risk than before of an economic deceleration that will be a bit faster than expected. So it's not the central scenario, but it's something we need to protect ourselves from, knowing that we have been performing very well in the first half of this year. So you need to protect as well a bit the performance. You can still go into and expose yourself to safe haven currencies. We do prefer Swiss franc at this stage in our portfolio, and we still have an overweight on gold in our portfolio. Apart from that, in our selection on the stock side, we do prefer domestic and stocks that are more highly, I would say, benefiting from domestic demand and not relying extensively from foreign demand and trades in our portfolio. So basically, that's why we have more Philippines exposures than before in our portfolio. We have a bit more China A compared to what we would have expected from a pure top-down point of view, just because we want to make sure that we have a bit more domestic play that will be more resilient should the geopolitical and tariff-related risk premia start to be priced in a bit more decisively on the market.
Right. And, your report has been very constructive about emerging market bonds and equity markets like Mexico, Peru, Hungary, and also highlights India and Korea in Asia. How do you balance your exposure across these diverse emerging market opportunities? And what role does Asia play in this broader EM strategy at Amundi?
So if you look into EM strategies, it's true that the carry is not there. It's not very much in Asia. And you have a lot of different spaces as well where you can find more appealing carry, but more volatility as well. In general, in our Asian portfolio or in a global portfolio, then India or even Korea bonds that you mentioned are taking very much sense. So first, I think we are currently having some flows coming back to the asset class. So Asia local currency bonds have been recorded foreign flows in year to date over 40 billion in US dollar, which is massive because it's part of a more structural change of, I would say, US dollar erosion as a safe haven asset. So this is quite interesting to see that. I would say from a portfolio management point of view, what is more important for me is to make sure that the correlation and the diversification I'm expected are eventually there. And we see unstable correlation with US dollar weakening in front of a steepening of the curve in the US or US dollar weakening in front of the drawdown on the US equity. And then I have an unreliable diversification. So this is one of the strong value creation, I would say, of having some currency bond in the portfolios that are in local currency bonds in the portfolio from emerging markets. Then, if we look into how can we play safe haven in a portfolio, knowing that we have fiscal deficits that is a commonality across various developed economies. So we are talking very much about the US with the beautiful bill that will eventually increase fiscal deficit in the US above 6%. But it's very much something that we are seeing in Japan and very much something we are seeing as well in Europe. So the fiscal deficit is increasing drastically on developed market curves. So if you manage a global portfolio, you need to find other areas that are potentially protected from further downgrade and that are having a fiscal picture that is improving. In that aspect, India or Indonesia curve are very strong candidate. Those are not safe haven per se because the rating is lower, but at the same time we see some fiscal consolidation there that is quite appealing and more than before, knowing that G7 exposure would have to be potentially reduced. When we look into Korea bond and Chinese bonds, those are more high rated, low carry. But now that you have a local FX that is way more resilient than before, you can definitely go back into the Korean curve or the Chinese government bond curves, and you ask yourself, would I have monetary policy easing going forward? Yes. BOK skip one, but eventually open the door for more cuts down the road. Same for China. We do believe that we'll have even more accommodative monetary policy, while they have been already delivering quite a lot. If you hedge back the currency, to come back to US dollar, you have actually a similar to higher carry than the US curve. So what is interesting to answer to your question is that you have in Asia and from an emerging market perspective, but as well as a global market perspective, the two areas you are looking for when you are a portfolio manager. You have the relatively safe haven curve that can play an alternative to G7, and those will be Korea or China government bond curves. And while you still have some good carry and good appealing opportunities with fiscal consolidation in India and in Indonesia, where we're happy as well to carry the currency underlying.
Right. Florence, so good having you on the show today. Thank you for your time and great insights and food for thought. Okay, on that note, we're going to take a very quick break. When we come back, we'll track the last half an hour of trade this afternoon.
Hi there, welcome back to Closing Trades. We're seeing visuals of the landing of the rocket carrying Shubhanshu Shukla and 3 others into the ISS, where they have spent 18 days and now they're landing back to Earth. This is happening off the coast of San Diego, and a splashdown is expected any second now. The parachutes of the nose cone of the rocket have come out, so that looks quite optimistic, and it's expected to be a safe splashdown. And well, this is the first Indian, that's Shubhanshu Shukla, the first Indian in about a very long time, in about 4 decades, to have gone to space, and he's making his return journey along with 3 other crew members, and they were on the ISS over a course of 18 days for maintenance services over there. And well, that's the live visuals that we're seeing. The splashdown expected any minute now. Remember, the undocking of Axiom 4 happened around 5:30 p.m. yesterday from the ISS, and we've just had had live updates coming in from SpaceX, wherein we now understand that the deorbit burn has been completed and the splashdown is underway, and this is happening in the Pacific Ocean off the coast of San Diego. So those are the live visuals on your TV screen.
Oh, that's a pretty cool view.
Yeah. That's right. Maintaining the vehicle signature through things like cloud lighter and any kind of atmospheric disturbance allows us to maintain visual contact with the vehicle as it's making its final descent for its water landing.
And it's a little foggy, as you can see there.
Yeah, Pacific fog is rolling in.
We've got some very bright lights as Dragon, you can see the ocean there. Dragon is about to touch down in just a few seconds here.
And working their way towards the vehicle are the SpaceX and Axiom support teams that will be present for the next phase of our splashdown coverage today. At this point, we'll be waiting for confirmation of the crew's safe landing, and then we'll move into the phases of this mission, which are really, let's recover the vehicle, let's recover the crew, let's make our assessments, and at that point, we'll be covering.
And we have splashdown of the AX4 crew back on planet Earth.
Welcome home.
SpaceX Dragon splashdown. We are in Stable 1.
SpaceX copies splashdown in Stable 1. On behalf of SpaceX, welcome home.
And thanks for the great ride and the safe trip, and Grace is happy to be back.
We are happy to have you back home safely as well.
Some words between the Corps and our commander, Peggy Whitson, as the AX4 crew has made it back home, splashed down at
Dragon. SpaceX, for your awareness, SISTI system verifications are in progress. I will report back when recovery personnel are en route.
Dragon.
Yeah, so now you can see a couple fast boats are going to be approaching the Dragon spacecraft. They're going to start with making sure that the spacecraft is safe. They're going to do some sniff checks. They're going to pick up those main parachutes. As Dragon splashed down, the chutes were immediately cut to make sure there's no safety issues there. So we'll pick up those main parachutes up. Once the crew deems that the spacecraft is safe, then our recovery vessel Shannon can begin to approach and begin the recovery process. So we are now eagerly waiting on recovery of our Dragon spacecraft with the AX-4 crew. Dragon has already autonomously completed several steps to save itself following splashdown.
So for those of you just joining us, the return of AX4 has gone smoothly so far, and we just got great confirmation that crew has splashed down. So Dragon successfully re-entered the Earth's atmosphere.
Well, that's a safe homecoming for all the astronauts there. But we will continue tracking, that story. But for now, we're going to take a very quick break. When we come back, we'll continue tracking markets.
Welcome back to Closing Trades right here on Nifty Now. And the markets are holding pretty well for themselves when it comes to Nifty 50. Over 100 points of gain is what we are still holding at, while Nifty Bank is now seen to be nudging closer to that 57,000 mark as well, still holding on to the gains of over 200 points as we speak right now. But where are the markets headed from here on? And just for the last few minutes, what should your strategy be like? Let's also get you some ideas. And we are being joined by Varun Goyal, Senior Fund Manager, Equities of Mirai Asset Investment Managers, as well as Sharan and Shivangi are also with us on the show. And Shivangi, firstly, help us with your take on the benchmark indices. How do you sense the markets right now? And what sort of a movement are you expecting on the markets from these levels?
Good afternoon, Aisha. Thank you, Shrishti, for having me. So we've seen that the Nifty index has rebounded quite well, and we've seen the bulls becoming active around about at 25,150 marks, where the sharp call writers have unwinded their position. So clearly, the bulls are back at the base, and we've seen that after the softness of the last 4 trading sessions, negation has happened, and Nifty has taken a support exactly at its 50 daily exponential moving average. So over and above, the indices look quite positive. The market breadth also kinds of, adding to the flavor of the up move that we've seen in today's session. So we are going for buy on decline strategy, and next levels that we're looking at is 25,400 immediately and 25,650 marks for Nifty, with a support of 25,000, which is also a psychological level, but also respected, on the yesterday's trading session. Of course, talking about Bank Nifty, the smaller banking names have been holding this index, and we've seen PSU show, resilience over here, which is helping it hold, nearly above 57,000 levels. So this one is to watch out for the next marks of 57,750 marks with a support of 56,650 levels.
Right. Sharan, hi, afternoon. Are you still maintaining your bullish stance on Realty names, as was the case in the morning?
Good afternoon, everyone. So we have seen quite a bit of selling from higher levels, especially we gave a buy call on Prestige. I think it's given up all its gain by now. So we'll wait and watch to see if we get a reversal. But looking at Nifty and Bank Nifty, a very strong performance. And I think if they continue this upward trajectory, definitely you will see again a turnaround in all the real estate names, since it's a high beta sector and always follow the direction of Nifty and Bank Nifty. But definitely we'll have to wait a day, because today I think from top, all of them have seen quite a bit of selling coming in.
To take on the real estate group of stocks, but we also have Varun Goyal joining us on the show. Varun, hi, good afternoon. Give us your sense on the entire auto pack. Lots has happened with Nifty Auto today. You have news flow. It's the top sectoral gainer. Hero Moto is outperforming the market right now. And also, of course, Tesla's entry into India with its new Mumbai showroom. So lots has happened with Nifty Auto today. Where do you see auto as a pack headed?
Yeah, good afternoon. Thank you so much for having me on the show. I think broadly, as far as auto is concerned, and for that matter, various cyclical sectors, we believe the growth outlook should get better because of the significant monetary easing that we have seen so far this financial year. And I think with inflation data continuing to remain benign, we expect further rate cuts in the month of August. So our sense is, as EMIs reduce both for home loans and auto loans, the auto sector should benefit. We expect a revival in sales as far as passenger car industry is concerned. Even on the two-wheeler side, our sense is that the sales growth should get better as we approach the festive season. So we like companies in the tractor space, considering the fact that the monsoon continues to be good. The higher-end motorcycle space and SUV space also continues, and the premiumization story in the Indian vehicle market continues to play out. So we'll maintain a constructive stance on the auto space going forward.
All right, so remain constructive with respect to the auto space, and select pockets are looking good. But the other pocket that is not doing that, that is actually doing well, is actually the chemical pack. And well, of course, Rallis India is something that came out with a very good set of numbers. But Varun, what's your analysis on the chemical pack? Because of late, a lot of these stocks are showing momentum, but any particular pocket within that you are liking at this point?
I think as far as the chemical sector is concerned, we have seen almost 3 years of down cycle. Post-COVID, post-pandemic, the Chinese supply came back in a very significant manner, because of which there was pressure both on realizations and volume growth. I think incrementally we'll be more positive on specialty chemical names. I think companies which are in the battery chemical space, which are focusing on creating electrolytes and other battery-related chemicals, that's a niche theme which is expected to do well. I think broadly, I know some of the water treatment and purification related chemicals, that is also a thing which looks interesting, and so we would be positive on the sector in a selective manner.
Right. Shivangi, in terms of a trend today, or rather for the next immediate future, where is it that you're sensing leadership and where is it that you're sensing weakness now on the charts?
Absolutely. If we talk about the leadership, I think some of the stocks which are showing reversal are, the diagnostic and lab-related counters, which may also include hospitals. This is one sector which is kind of now having a good risk-reward. But of course, the leadership continues in the NBFC space stocks and the PSU banking names, which has been resilient despite the market fall. So few of the PSU banking names are quite positive, like RBL, CanBank. These are showing really good signs of open interest addition here, and consistent ones. Apart from this, some weakness could be seen. There is, of course, there is some revival in the auto pack, but there are selective auto stocks which are still showing some signs of weakness. And apart from this, I feel some of the metal or specifically steel stocks could be ones which could add a little bit of open interest on the short side.
So that's the take on some of the counters where Shivangi is seeing value, whereas some could be underperformers. But let's once again talk about earnings candidates, and HDFC Life is all set to report its Q1 earnings. Let's go across to Varun Arora to get us more details on what the street is penciling in and what can we expect to watch out for when the numbers actually do come. Varun.
Yes, on the HDFC Life, what we are expecting the positive result. The APE may grow by 13.7% on YY basis to 3,259 crores, whereas VNB is expected to grow by 15.2% on YY basis to 827 crores. For the VNB margin, for the last 3 quarters, that expanded by 220 bips points, whereas now we are expecting another 30 bips to expand to 25.4%. What we need to watch out for, which is the product mix, any guidance on the sales through bank and agency channel, as well as the margins.
Okay, that's the expectation coming in from HDFC Life. Just looking at the market construct right now, while Hero MotoCorp, of course, has picked up nicely. There's Sun Pharma, Bajaj Auto, Wipro, M&M. These are all names which are scaling up quite nicely in trade. In fact, autos as a sector is actually taking the charge right now. There's, of course, KEI, there's BSE, there's CAMS, and Piramal Pharma, which are also some of the standout winners. Sharan, let's get a chart check going on both KEI as well as BSE and whether you think the gains will stay.
So KEI has an excellent chart, again broken out quite strongly today on high volumes, and I think this trend can continue. It took a slight dip towards its 200-day moving average, where it saw a very good reversal on high volumes. I think the trend can continue in the coming day. But a decisive breakout would be around about 3,000. If it closes about 3,900, you can see levels of 4,200 to 4,400, 4,500 levels. So KEI is again very good. And in BSE, I'm not too positive. Again, you have seen a small reversal, but the reversal is not backed by volumes. Volumes are very low compared to previous sessions. So I would wait again for it to actually close above the 50 or the 20-day moving average to take a view if it's actually turning back to the positive side or it's just a small reversal and then the selling continues in the near future. So volumes are not that great. I will have to wait and watch. So where it closes in the next 2 or 3 days.
What is your own sense on the entire capital market theme? And do you think that the best is now behind us? Varun, the question is for you.
Sure, Aisha. So I think now capital markets remains a secular theme. I think for the next 10 years, we expect significant increase in financial savings as more and more investors shift from physical savings to financial savings, asset management, insurance, capital market, depositories, brokerages. This sector should continue to see significantly higher growth than the broader market. Of course, valuations continue to be a challenge in the space. I think most companies are trading at significantly higher valuation than the broader market. So one needs to be selective, but broadly, I think the growth outlook remains strong, and selectively, there are several opportunities to invest.
All right, so that's the take coming in on the capital market space. But Varun, what do you make of SBI right now? Because there are reports suggesting that the company is planning for a big fundraise, and even tomorrow they have a board meet to approve the fundraise. The final amount is something that we will be watching out for. But what can it really mean for SBI? Because this fundraise and this bigger size of fundraise is actually coming after 7 years, I believe.
Well, I will not be able to comment on any stock specific name, but broadly we remain constructive on banks and NBFCs. Yeah.
About that sector, Shivangi, we've seen earnings coming in from Bank of Maharashtra today. A mixed set of numbers coming in. On the growth front, they have seen good numbers, but their asset quality has remained unchanged on a sequential basis. Shivangi, what's the chart check on Bank of Maharashtra? Because this stock, we have seen some momentum lately.
This has actually negated its lower top, lower bottom formation of the last 9 trading sessions, and we're seeing quite a lot of momentum build up here. Of course, a lot of tailwind from the other PSU and smaller banking names as well. So, of course, this one is on the radar for a good upside. But of course, there is some sort of resistance which is still present at around about 58 levels, which it needs to cross for the next fresh leg of rally. So once it crosses 58, I think it is a better risk reward at those levels. So we'll wait for that then again to cross 60 zones.
All right, that's about Bank of Maharashtra. Well, indeed, yes, a lot of these PSU banking majors are having good gains in today's trading session. But other than that, within financials, Sharan, any other stock within the NBFC space that you're liking at this point in time, given the fact that Shriram Finance, Bajaj Finserv, these are your movers in the Nifty 50 side. So yes, we know that you have been tracking PEL and the targets are also hit. But other than that, any other stock within this space is looking good to you?
So Shristi, exactly like you said, Shriram Finance is looking good. Even on valuation terms, I think it's one of the cheapest NBFCs out there, around 2.25 times to book value, compared to your Bajaj Finance trades at around 6, Chola around 5.5 to 6. Even on a fundamental basis, the risk-reward ratio is good in Shriram Finance. Even on technical terms, I think it's just around the corner for a breakout. Again, taken nice support around its 50-day moving average, consolidated for around 1 or 2 weeks. Now, I think it is looking like a good breakout about 690 odd levels. I think if it gives a breakout about 690, you can see levels of around 700 to 710. And even I think recently also I'd given a buy call. And I think looking at the chart, it has consolidated for a very long time, since September 2024. And if around 710 odd levels, it can give a breakout. Actually, you can see an all-time high coming in Shriram Finance. So overall, banks, NBFC, PSU banks are all looking good. Most of the benefits will trickle down from the next quarter. And from the next 2-3 quarters, you will actually see the fundamentals also impact a bit.
Right. Varun, where from this earnings season are you expecting meaningful positive surprises, if at all?
Yeah. So I think FY26 is a year of cyclical recovery for India. We expect significant revival in earnings growth compared to 3-4% for FY25. We expect 11 to 12% growth for the year as a whole. I think the first quarter would be more like 7-8% because I think the growth will gradually improve as we move into the festive season. I think last year, the two large sectors which were reported very poor earnings, one is oil and gas, because the refining cycle was going through a bad phase, and second is metals. I think both these sectors should see significant uptick in earnings this year. Also, I think the capital goods cycle will continue to be fairly resilient and strong. So we expect earnings as far as capital goods space, defense, PSUs, railways, that segment to continue to hold on. I think again, capital market is one segment where earnings should remain quite good. I think NBFCs again, something which will show resilient earnings. Banks may see NIM compression for this quarter and maybe the next one. In the quarter 3 onwards, we expect the NIM, the rate cut benefits to start coming in for banks. So there, the earnings growth will be more back-ended. But I think overall, for the year as a whole, we expect Nifty to deliver 11-12% earnings growth. I think the small and the mid-cap spaces where we see significant acceleration in earnings. From a minus 15% earnings growth for the small cap space in FY25, we expect around 23-24% earnings growth for this year. And that should be really the big earning growth story as far as FY26 is concerned.
Lots of sectors to watch out for on the earnings front. Varun, thanks so much for joining us and sharing your view with us. On that note, we'll let you go. But time now to get some BTST ideas from our technical experts. Shivangi, you go first. Where are you placing your BTST trades for the day?
Absolutely. So we're seeing some of the consumption space stocks also picking up right now. As we speak, there is some long built-up seen here in this entire space. But one very remarkable short covering move can be seen in Marico, which has come out of its 6-day range. And this one is looking quite positive. We've seen that the last hour itself, the bulls have awakened and it is getting ready for a 770 level target with a stop of 725.
All right, so that's the buy call or BTST idea coming in from Shivangi. But Sharan, what about you?
So I like the PSU banking space again a lot. So this will be a BTST trade. You can buy Canara Bank at current levels. I think 114.5 with a stop loss of 112.5 with a target of 116.5. Again, you have seen a good recovery in hospital stocks, Fortis and Apollo. So you can buy Fortis Hospital at the current price with a stop loss of 779 and a target of 820, which will actually be its all-time high also.
And Sharan, before we just wrap up for the day very quickly, given the recovery we've seen today, where do you expect Nifty to open tomorrow morning?
So Snehi, I think last time Nifty gave a decisive breakout around 25,250. So that'll be a good resistance. If it can open around about that level and give a breakout, so you'll see the momentum continuing. Then 25,250 will be a small resistance for the Nifty, which is around about our closing also. So we can expect a good 20-30 point gap up kind of move tomorrow, and we'll see the follow up in morning session.
Shivangi, Sharan, both of you, thank you for your time as always. And I'm going to hand it over to Ashesha for the closing trades.
Well, yes, turned out to be a good day for the Indian markets. Nifty is ending nearly 138 points higher for the day, near that 25,222 odd mark. Nifty Bank is also up and away in trade. In fact, it is ending the day with gains of over 300 points, near that 57,100 mark. Broader market indices should also come up for you on your screens. Nifty Small and Mid Cap Index, both of them were gaining. Nifty Mid Cap Index up over 1%, and Nifty Small Cap Index also up 0.9% as we speak. In terms of individual gainers, we had Hero MotoCorp, which was the biggest gainer on the Nifty 50 index. That one was up nearly 3 to 4% in today's trading session, 4.5% higher for that counter. Bajaj Auto, Sun Pharma, Shriram Finance, Apollo Hospital, these were some of the other gainers from the Nifty 50 pack. On the losing side though, we had HCL Tech, which ended the day with a cut of nearly 3.5% after it reported its numbers yesterday. SBI Life, Eternal, HDFC Life and Tata Steel, these were also some of the big losers from the Nifty 50 pack. In terms of individual sectors, we had Nifty Auto Index, which was the biggest sectoral gainer today. Hero MotoCorp, that one was gaining in trade. TVS Motors and Bajaj Auto were all some of the biggest losers from the Nifty Auto Index. Pharma stocks were also shining bright. Natco Pharma, Biocon, Sun Pharma, Ajanta Pharma, all of them gaining in trade today. Nifty Pharma up for you on your screens, up over 1% in trade today. In terms of individual buzzers, we had Tejas Network. After it reported its numbers, the stock was declining. Very weak set of numbers that the company reported, the stock ending 6.5% lower. Remember, the company reported a loss of about 194 crores versus a profit of about 78 crores that the company reported same time last year. 6.5% gone on that one. Rallis India, this one reported very strong set of numbers. We had revenue which nearly doubled on a year-on-year basis, and a company reported a profit versus a loss same time around last year, although it cooled off a tad bit, ending the day 0.4% higher. We had Bank of Maharashtra, which also reported its numbers. NII up 18%, PPOP up 12% on a year-on-year basis. That one is also up 2%. We had HDFC AMC, where Nomura came out with a report. They are maintaining their buy stance. 5,500 is their target price. CAMS, where Motilal Oswal maintained its buy stance. 5,000 rupees is their target price. HDFC AMC was gaining nearly 5%. CAMS also up nearly 3% in trade today. So we had a whole host of buzzers from the broader markets, but on the index level, Nifty is ending about 0.5% higher for trade. 25,217 is where it is ending for the day, and Nifty Bank also ending nearly to 250 to 300 points higher. That's all the time we have on this edition of the show, but don't go anywhere. More news and updates will continue on the other side.